Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Ngwiri and I'll be taking you through alternative investment analysis block revision. We are looking at November 2015 question 4. Part A reads as follows: evaluate 4 ways in which investors could participate in commodity markets. And we are going to mention the following. So we are looking at November 2015 question 4. So A, we are going to say the ways in which investors could participate in commodities include number 1, you can say number 1 over there, the outright purchase of the commodity. Outright purchase of the commodity. This implies that if you are interested in investing in gold, so what happens is that you would be able to remove a specific, because gold is purchased in say ounces or that kind of metric system. You can be able to buy a given number of ounces with a given amount of say dollars or even Kenya shillings like that. So we are saying that the outright purchase of to seek exposure towards commodity prices, how you can be able to invest in commodities is by outright purchase of the commodity itself. So we're saying gold, copper, silver, like that can be bought from a commodities market, there. But 2, the second way in which investors could participate in commodities is by buying exchange-traded futures. By buying exchange-traded futures which track prices of commodities. Prices of commodities. So you buy an exchange-traded fund or exchange-traded, this is exchange-traded fund, not futures, sorry, exchange-traded fund that is specifically constituted to track a specific commodity or the price movements of given commodities. So this is maybe an exchange-traded fund, an ETF, what we call an ETF, that deals with say copper. So one way investors can seek exposure towards investing in commodities is by buying securities that have actually been trading that seeks exposure towards the copper. So you invest in this exchange-traded fund that tracks the movements of commodities. In this case, we're talking about the copper, like that. That is how investors can be able to alternatively seek exposure. Number 3, managed futures. And we say is a derivative. Instrument which is derived from the price. It's derived from the price of another security. Another security managed by a professional. So we're saying managed futures is the third type of third way which investors can be able to seek exposure towards commodities. And we're saying that it is a derivative instrument which is derived from the price of another security and managed by a professional. So that professional will be able to note or try to seek exposure towards commodities by investing in managed futures there. So they are managed by professionals there. Number 4 is investing in an index or mutual fund that pools commodities, and allows investors to earn returns based on commodity spreads. Those are the 4 ways in which investors can be able to seek exposure towards commodities. The first case we have is the outright purchase. The second one is buying exchange traded funds. Here it is managed futures, and here we're talking about investing in an index or mutual fund that pools funds or that pools commodities in which investors can be able to consider seeking exposure towards commodities there.